Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. If you like making money, subscribe to the channel. This channel's for you. I'm sure we'll get some opportunities in front of you. Give me a thumbs up if you like this content. So today I'm going to talk about riding on the edge, and really this is about portfolio allocation and why I spread my money out. There's a couple of questions. It's like spread your money out and just hope. No, no, no. That's not how it works. I'm not hoping. I'm strategically placing a bunch of bets, and I'm going to show you why I'm doing that. So let's get into riding on the edge. And I do this with some of my picks. So why I spread out my money. I never put more than about 3 to 5% of my money into one position of my entire portfolio. So that's 3 to 5% of the entire portfolio. To get very outsized returns, typically you need to go into companies that carry a lot of debt. These get shorted very heavily into near-death bankruptcy experiences. I could get caught in a company that goes bankrupt. So that's one of the reasons why I limit my position size to 3 to 5%. Because if you get caught in a bankruptcy, and let's say you have a total loss of a position, it's not going to be more than a few percent of your entire portfolio. At most, it'll be 3 to 5%. So that's one reason why I limit it. Now, I'm talking again about portfolio allocation. Some of these companies are going to go up 100 to 1,000x. That's what the returns could potentially be if you're getting into these companies when they're pennies on the dollar, when you're really getting them driven down into the ground. Since the upside can be so great, I like to spread my money about all of the companies. So a small amount of money on a return between 100 and 1,000x is worth spreading the money around. It can be such a large return that it's better to spread it and get it on one of them than it is to not spread it and get it on none of them. That makes sense. And if maybe you're lucky, you find the company that has that you caught the bottom with a whole bunch of debt that didn't go bankrupt. They had really good assets, and then it just rockets when the commodity price turns around. In a sector like uranium, where there isn't a ton of companies and the potential is so great, I'm just going to spread my money amongst basically all of them. They all lasted the test of time in this massive bear market, which has completely just destroyed a whole bunch of companies. These are the strong companies. They probably have very good assets. There are reasons that they're still around. And if there's only 30 of them, 30 really good picks or 20 really good picks, you could put money in all of them, and it's not that hard to get money in each one of them. If one of those returns between 100 and 1,000x, you'll be glad that you put some money into it. Now, these are asymmetric bets. That's what we're working with. Wherever you have massive ability for returns, I typically spread the money out and I go after the home runs. I do this with options trading the same way. If I get a position that gets wiped out, it doesn't hurt the overall portfolio. In fact, I just had some positions return 500 to 800% in 2 weeks on my MUX call options because nobody was looking at MUX. Nobody cared about the company. I've not had a complete loss yet in options, but again, I have been trading options for a super long time. So that's one way that you handle risk in a portfolio using asymmetric bets. The asymmetric bets, which can return many multiples of your original amount, can cover any losses that you have very quickly. So spreading the money around, it lowers volatility, it lowers risk, it better captures the gains of the sector. And what I like to do is I include riskier companies as well. I don't just, hey, they don't have any debt. I actually go after some of these high debt ones because those are the ones that are going to return the most. It's the high cost, high debt. I should say not just high cost. It's the high cost producers and ones that carry debt that really get slammed into the ground. That's where you're going to find that value. And I've got a 5x, a 10x, and a 100x. And let's just say you put $1,000 into each. The returns would be $5,000, $10,000, and $100,000. Now, if you added those first two up, the 5x and the 10x, let's say you're more of a conservative investor, those two companies would only make up 13% of the total return of those three companies. So what you want to do is you want to spread it out and you want to try to ensure to get at least a couple 100xers in there. And I know that sounds ridiculous. I know it's like, oh man, nobody gets 100x. Well, I'm already up 600-700% on my SM Energy investments, and we're at a 35-to-1 ratio of oil to gold. And oil's got a long way to go. So it can happen, and it probably will happen with some of the companies that are in my portfolio that I spread out and captured. So the conclusion here is I research the companies and sectors. This is not a hope strategy. I'm not basing it off of I hope they go up. It's a strategy to capture all of the gains I can from a sector. I also target high debt companies, and those high debt companies, they do carry a lot of risk, and that's why I spread my risk out. I do technical analysis as well to hopefully limit the downside. I limit losses to the portfolio by doing this portfolio allocation. I'm not going to put 50% of my portfolio in one company and then get smoked in it. And again, I still overweight good management and companies that have better balance sheets with better management and better money management. So that's my strategy, and that's what I'm using for these large asymmetric bets in this commodity bull market. I'm spread out. I wouldn't say I'm spread thin. I'm just spread out amongst the best sectors with the best leverage to the commodity bull market with the most knowledge that I have. So I'm in uranium, I'm in oil and natural gas, I'm in some of the base metals, I'm in royalty companies, I'm in precious metals, especially silver. So those are the sectors I like. I spread my money out. I have some explorers, I've got some developers, I've got some producers. I spread it all out. That's how I reduce volatility in the portfolio. I reduce risk in case one or two of them go bankrupt. And if one sector is underperforming another sector, you can get that nice smooth portfolio gain over time if one sector is underperforming and another sector's outperforming. It's that simple. It's a way to handle emotions. It's a way to handle risk, and it's a way to recover if something goes wrong. If you guys like this content, subscribe to the channel. Give me a thumbs up. I appreciate you listening. This is Finding Value.